Hey investor friends, I'm Michelle Markey and welcome back to my channel. If you haven't already, it would mean a lot to me in the YouTube algorithm if you could please like and subscribe to my video and YouTube channel, because the stock market is rejoicing with consumer price index inflation coming off its 40-year highs of 9.1% in June down to 8.5% in July. So a lot of stocks are up, including some big tech favorites like Google and Microsoft. And even though they missed their earnings, a lot of people are piling into some big tech favorites that they perceive to be safe haven stocks as a hedge against inflation. But according to the Wall Street Journal, it looks like the higher than average inflation we're seeing is actually hiding the magnitude of our economic slowdown, as total consumer household and business spending is either flat or falling. And also even grocery store spending is down over the last 6 months. So I think what legendary investor Warren Buffett said about how inflation is swindling almost everybody is still as relevant today as it was when he first wrote about it 45 years ago in a Fortune article, and also when he repeated an answer to CNBC's Becky Quick when she asked an investor question about how inflation is still swindling equity investors. So I'll repeat that clip and also cite some excerpts of what he originally wrote about it, because even though people are favoring stocks right now, I think that this might be a red herring where there could still be way more trouble ahead, even though a lot of people think that the Fed is going to only raise the Fed funds rate by another 1 to 1.5% to cap it out at 3.5 to 3.75% by spring 2023 before they have to cut rates again. And that means that a lot of people think that stocks are cheap right now. But I think that we would all be wise to listen to the wisdom of Warren Buffett in what he says, because inflation is definitely a tapeworm that definitely makes businesses have to work harder. And even though companies like Google and Microsoft are really high quality businesses, they're still having to deploy more capital and retain more earnings just to basically stay in place, because inflation is acting like a quicksand. So without further ado, let's listen to what Warren Buffett said.
He writes, in the 70s, you wrote an article entitled "How Inflation Swindles the Equity Investor." You said that stocks cannot keep pace with inflation because companies cannot increase their return on equity. Do you believe that this is still the case?
Yeah, and of course, bonds can swindle the equity investor too. Everything, inflation, I should say, swindles the bond investor too, and it swindles the person who keeps their cash under their mattress. It swindles almost everybody. And the problem, if you have a business that doesn't take any capital, and let's just say the dollar depreciates 90% or something, so things cost 10 times as much. If it doesn't take any capital, you can charge 10 times as much, and you've kept your relative position. But most businesses take some capital. If our utility business, just say that the dollar is worth 1/10 some years hence from now, we have to have 10 times the capital investment basically, and we get paid a return on that. But we have forced capital investment to essentially keep them in the same place. And I wrote an article that related to that, and I will tell you one famous story which you will all sympathize with, and that I wrote that story for Fortune, and when I finished it, it was about 7,000 words. And Fortune didn't like publishing 7,000 words, and they had my friend Carol Loomis explain that to me, knowing that I would pay more attention to her than anybody else. But being stubborn and male, I said, every word is precious, and they can either run it or not. So then they sent an editor, a very nice guy, out to Omaha. And this guy explained to me that it just wasn't right to use that many words. And I said, well, that's fine, but if you don't do it, I'll write it someplace else or something. Very disgusting behavior on my part. And then I sent it. It was beginning to bother me a little. So I sent it to my friend Meg Greenfield. And Meg was a great, great, great editor at the Washington Post, and we were very, very good friends. Wonderful woman. And Meg, who was tough as nails with most writers, but she was kind of nice. She didn't want to really hurt me too much. So I said, well, May, what do you think? And she said, well, Warren, she says, you don't have to tell everything you know in this article. And it made the point. And so I'd write that article shorter, but I'd say more or less the same thing. No, you're better off if you really could have a totally stable unit of monetary use for the next 100 years. It would be better for business and investors in general. Charlie? No? We will go to station 6.
And just when you think Buffett's going to move on to the next question at the 2022 Berkshire Hathaway shareholder meeting, he actually continues talking about inflation, and it's uncanny how he almost repeated what he wrote 45 years ago in saying that nobody knows what the inflation number will be, even though it's projected according to Fed data that the 10-year break-even inflation rate is 2.5%, which means that a lot of people are thinking that inflation is going to come back almost down to normal at the 2 to 3% average it's been for the last several years. And even though that's not what Buffett had projected 45 years ago, he was actually pretty close to the money in what he believed the average would be. And we actually came to 7% CPI inflation in December 2021. So I don't think Buffett was too far off. And he opined as follows in saying that discussions regarding future inflation rates usually probe the subtleties of monetary and fiscal policies. These are important variables in determining the outcome of any specific inflationary equation, but at the source, peacetime inflation is a political problem, not an economic problem. Human behavior, not monetary behavior, is the key. And when you very human politicians choose between the next election and the next generation, it's clear what usually happens. However, it seems quite possible to me that inflation rates will average 7% in future years. I hope this forecast proves to be wrong, and it may well be. Forecasts usually tell us more about the forecaster than of the future. You are free to factor your own inflation rate into the investor's equation, but if you foresee a rate averaging 2% or 3%, you are wearing different glasses than I am. So there we are, 12% before taxes and inflation, 7% after taxes and before inflation, and maybe 0% after taxes and inflation. If my inflation assumption is close to correct, disappointing results will occur not because the market falls, but in spite of the fact that the market rises. I can almost hear the reaction of some investors to these downbeat thoughts. It will be to assume that whatever the difficulties presented by the new investment era, they will somehow contrive to turn in superior results for themselves. Their success is most unlikely, and in aggregate, of course, impossible. If you feel you can dance in and out of securities in a way that defeats the inflation tax, I would like to be your broker, but not your partner. So I think it's really interesting how Buffett had this to say back then, and how even though people might be trying to beat inflation right now by having their money in stocks, unfortunately, all of us are losing out, but maybe those who have more invested in stocks are losing a little bit less than those who might be hiding cash under a mattress.
Inflation is, the question is how much, and the question is whether you can decide that 2% and keep it. The answer is nobody knows. I mean, you do not know, and nobody knows. You can list all kinds of stuff, but nobody knows how much inflation there will be over the next 10 years or 20 years or 50 years or next month. And people talk about it all the time because you're interested in knowing the answer to your question. And they don't know the answer, but there are a lot of people that will tell you they know the answer if you pay them enough, and other people that will tell you for nothing because they think it enhances their prestige and makes them more valuable and all that. But the answer is they don't know, and we don't know either. The best protection against inflation, though, still is your own personal earning power. If you play the violin very well, you will do reasonably well during inflation. I mean, play it better than other people. People will pay you for doing that if you, all kinds of things. So your skills will not be taken away, and your money may be. Okay, station 6.
And while it's great for us to focus on our individual earning power as the moral of Buffett's inflation story, at the same time, he also wrote 45 years ago that unfortunately the major problems of high inflation flows not to investors but to society as a whole, because investment income is a small part of national income. So it would be great if real income per capita could grow at a healthy rate alongside zero real investment returns. But unfortunately, we haven't been seeing that play out, where it looks like over the last couple of years, from the end of 2019 to the end of 2021, that real GDP per capita only grew by 2.7% compared to how CPI inflation grew by 4.7%, or a ratio of about 2 to 1 of inflation outflanking real GDP per capita. So unfortunately, society is not advancing as much as it could be. And as far as business performance is concerned, he also wrote that on balance, however, new equity flotations and retained earnings guarantee that the equity capital locked up in the corporate system will increase. When prices continuously rise, the bad business must retain every nickel that it can, not because it is attractive as a repository for equity capital, but precisely because it is so unattractive. The low return business must follow a high retention policy if it wishes to continue operating in the future as it has in the past, and most entities, including businesses, do. It simply has no choice. For inflation acts as a gigantic corporate tapeworm. That tapeworm preemptively consumes its requisite daily diet of investment dollars, regardless of the health of the host organism. Whatever the level of reported profits, even if nil, more dollars for receivables, inventory, fixed assets are continuously required by the business in order to merely match the unit volume or the previous year. The less prosperous the enterprise, the greater the proportion of available sustenance claimed by the tapeworm. A business earning 8% or 10% on equity often has no leftovers for expansion, debt reduction, or real dividends. The tapeworm of inflation simply cleans the plate. And we see this playing out even with very good high return businesses like Google and Microsoft, where we see their return on invested capital decreasing while their retained earnings are increasing to try and offset the tapeworm effects of inflation. So even though that might seem a little bit confusing, and even though these very good big tech companies of Alphabet and Microsoft are doing it, it seems like no one is out of the woods yet when it comes to the gnarly effects of inflation. So we can just hope that even if inflation causes some market scares in the future, that maybe we can buy some of these really great businesses on sale someday. And that's the light at the end of the tunnel that I'm ultimately looking forward to. And if you found this video helpful or enjoyed it, please like and subscribe. And I wish you well on your journey to being the best investor you can be. Till next time.